Hello, this is Japanese Economic Review Channel. Today, we present the July 2026 Tokyo CPI report. Headline inflation rose to 2.0% YOY, expanding from 1.7% in June. This acceleration signals a critical macro shift. In this session, we will dissect the underlying drivers, examine energy policy impacts, analyze the structural goods-to-services divergence, and contextualize this print within a historical half-century trajectory as Japan breaks its long deflationary cycle. Our baseline metrics show robust, broad-based stability. Headline inflation hit 2.0% YOY, with core at 1.9% and core at 2.0%. Notably, all three indices grew month-on-month, headline by plus 0.4%, core by plus 0.3%, and core by plus 0.3%. These synchronized monthly gains demonstrate that underlying inflationary pressure remains highly resilient, matching the Bank of Japan's 2% target even after filtering out volatile fresh food and energy. Looking at the long-term trend since 2023, we see a massive cumulative shift. Tokyo's price level has expanded by 12% to 13% since the 2020 base year. Headline stands at 113.2, core at 112.6, and core at 111.9. This is not a short-term blip. It is a permanent compounding of price levels. This steady upward trajectory represents a structural departure from Japan's long-standing zero inflation era. To understand inflation, we must look at the basket's weights. Housing commands 27.6%, and food holds 25.3%, combining for over half of the entire index. Fuel, light, and water represent just 5.6%. Because of food and housing's massive weights, even small price hikes in these categories exert a powerful gravitational pull on the overall CPI, completely overshadowing double-digit percentage swings in smaller, more volatile categories. What drove the 0.3% jump in headline inflation from June's 1.7%? The primary catalyst was not a sudden spike in operational costs, but rather a shrinking negative drag from energy, which added a net upward pressure of plus 0.09 points. This reflects the wearing off of government utility subsidies. Combined with modest increases in fresh food, plus 0.07 point, this technical policy shift is what pushed headline year-over-year back to 2.0%. Let's break down the 2.0% headline figure. Food excluding fresh food rose by 3.9% YOY, contributing plus 0.93 percentage points, nearly half of all inflation. Housing added plus 0.38 points, while fresh food added plus 0.21 points. Conversely, energy drag was almost neutral at minus 0.04 points. This waterfall illustrates that daily essentials, particularly processed food and housing costs, remain the dominant source of inflation for households. A major structural divide exists between goods and services. Tangible goods grew plus 2.9% year-over-year, contributing plus 1.34 points. Services, despite a larger 56.6% weight, grew only plus 1.2% year-over-year, contributing plus 0.65 points. General services grew plus 2.1%, but were dragged down by a negative 2.5% drop in public services. This gap indicates that a broad-based wage price spiral has not yet fully materialized across Tokyo's wider service economy. Our sector heat map reveals a stark divergence. Food, plus 4.0%, and furniture, plus 3.4%, maintains strong multi-year upward momentum. Education stepped up to plus 2.0%, and transport rose to plus 3.0%. On the downside, miscellaneous fell negative 6.5%. This wide performance gap shows that while core operational sectors are rising, cost pressures are highly unevenly distributed, presenting a complex puzzle for monetary policymakers. To conclude, let's look at Tokyo's inflation since 1971. Following the 1970s oil shocks and the 1990s bubble burst, Tokyo suffered two lost decades of structural deflation. Today's stable 2.0% print confirms we have definitively escaped that deflationary gravity. We have entered a new macroeconomic regime where regular wage hikes and price revisions are becoming a normal, healthy part of Japan's economic landscape. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.